Hi everyone, Billy here from My Day at the Trader, and welcome to the third section of our overall risk mitigation strategy, which will deal with drawdowns against the high watermark of your portfolio. Now, I just want to quickly remind you of the risks that you face as a trader, one being that you never want to be exposed to one event that wipes out your entire trading capital. And for this measure, we have the percentage risk rule to protect yourself against. The second measure is you don't take your profits too soon relative to the overall risk that your strategy exposes you to in the market. And the mitigant that we're going to use against that point is the required rate of return, or the risk-reward relationship, in conjunction with the historical win rate. And the last point is, how are we going to address the risk of our capital fading away? And that's what we're going to look at in this video today. So as part 3 of a risk mitigation strategy, we're going to finally now complete the circle. We've looked at percentage risk, we've looked at the trade statistics, and now I want to explain to you a very, very powerful tool used by professionals to ensure that they protect not just their normal initial capital, but as the portfolio grows, that the overall capital, including the new ones, are safe and looked after. So the concept that you need to become quite familiar with is max drawdown, and we reference it against a high watermark of your portfolio. Now, what does that mean in practice? In essence, what we'll look to achieve here is, once we have the two risk mitigants in place, in other words, the percentage risk per trade, and we make sure that those trade statistics works in our favor, we still bank on the fact that we will be losing trades. And it's not a given that in all circumstances, every time we make a winner, it will make more than what we lose on the losing trade. So you can find yourself slowly but surely drifting downwards in your portfolio. And this is where traders, especially when you start out, drop the ball. They never really consider that a drawdown is in fact the thing to protect, because they think once they've got those other two measures in place, that their portfolio is protected against self-destruction. So what we're going to implement here is we're going to have a rule that says, if there's 15% of your capital lost, you need to sit upright, relook at the situation, and maybe start reducing your risk. Once you hit 20% of your capital that's lost, that's 80% now of the value left over. You definitely have to take a break. You physically get up, you walk away, you don't trade for a week or two, clear your head, reevaluate your strategies, reevaluate all your risk parameters, because that is the most important part of making sure that you stay in the game. So what I want to show you here is, let's say you start off with $10,000 on a trading account, and via successful management of positions, you manage to trade that up over time to have a portfolio value of $50,000. The last thing you want to do and to see for your portfolio is for the entire value to drop down, let's say as in this example, to $8,000. And now in isolation, if you just look at the $10,000 you started off with and the $8,000 left over, technically you've lost 20% of your capital. So in theory, you could say, well, I'm still in line with my drawdown level. I've only lost 20%, so I'm fine. Let's take a break here. But what you're missing is that's not the correct way to look at trading, because you're ignoring the fact that you were able to trade up your portfolio all the way to 50,000. So what we rather want to do is we're going to go into a situation where once we trade the position into a positive, we're going to mark the portfolio constantly. As you start trading, whatever that new value is, let's say that's 11 grand. 11 grand is now the measure from which you're going to be observing the 20% drawdown level. Okay? This way, as the portfolio goes up, your high watermark goes up the whole time, right? And you'll see the reason for that being is it's almost like a trailing stop when you do a trade. In this particular case, what you're saying is, as my portfolio grows bigger and bigger and bigger, I'm protecting not just my original capital, but also the newly acquired capital, so that whenever there's a negative in there, it's limited based on my newly traded capital. So in this example, I traded myself up all the way to 50,000. Now, if my high water level mark is $50,000, I'm going to measure from the $50,000, not from the $10,000, from the $50,000, I'm going to measure a risk drawdown limit of between 15 and 20%. And then as soon as the portfolio hits that level, I'm now going to implement what I said. So remember what I introduced you to the concept. When you put it down as 15%, once it measures 15% drawdown, you kind of take your foot off the pedal. You first, that's like the first wake-up call to say, okay, hold on a second, something's gone wrong with my trading strategy. Let's check all the covers again. Let's check the basis. Is my risk rewards level all right? What is now my historical win rate? Do I need a little bit more risk reward ratios in order to make up for that? You want to give yourself the room so that once you hit the 80% level, so in other words 20% drawdown, if by then you're in a bad space, you take completely a break from trading so that you don't mess with yourself. The honest truth is, as a trader, the worst thing you can do for yourself is to trade with a negative mental state. So by doing this maximum drawdown level, what you do is you're actually allowing yourself time to take a break. You clear your head, you come back with a refreshed look, and your mental state is not so bad anymore. Because what you can do now, from here, you now start small again. Let's say you put fewer positions on. You make sure that, let's say you were risking 2% perhaps per trade. You're now down to 1% again, even lower if you have to. Because the point being is from here, you allow yourself to continue from 40,000 upwards, not down at 10,000 on your original capital. So very simple, very, very simple rule this. It just helps you to keep an eye on the bottom line, and it ensures that you don't find yourself with a position where you traded away a ton of money just because you're observing the original capital invested. That's not the right thing to do. So what this allows you to do is, as you trade your capital higher and higher, it allows you to make sure that the bulk of the capital is protected. This is the key to longevity in the market, because you can take 10 breaks if you have to. As long as you just don't deteriorate your portfolio, every time you come back to the market, you start at a level that is worth it. You don't have to start right from the beginning again. And you might ask, why are we using 20% drawdown level as the ultimate break? The reality is that let's use an example. If you had $100 as a trading capital and you lose $50 of that $100, now you're left with $50, right? Now to trade your way back to your original starting point, with $50 invested, you have to make $50 to get back to $100, which means you need 100% return on your capital to get back to square one. So in this example, by limiting that to 20%, if you started with $100, you now have $80, right? Because that's where you took your break. You only now need to make $20 back. So $20 as a percentage of your capital, which is $80, is only 25%. Now, any trader can make 25%. If you can't do it in a year, you can definitely do it in 2 years' time. But what it does, it gives you a fighting chance to remain in the market. And that's all really that we want to do. Okay, so this is the final component of the three-pronged risk management approach. And once we start trading real money, I'll show you how I use all three of those risk mitigants consistently, continuously. You'll never let that stop, to make sure that you keep all the balls in the air and that your portfolio is always protected. All right, thank you very much, and I'll catch you again on the next slides.